Something very strange has happened in financial markets. Stock prices keep rising. Real estate prices keep rising. Crypto prices explode upward, even when economies slow down, even when debt levels reach historic extremes, even when governments struggle with deficits. How is this possible? How can asset prices continue climbing while the real economy becomes more fragile? The answer is not what most people think. It is not innovation. It is not productivity. It is not corporate growth. The real answer is something far more powerful. Liquidity. Liquidity is the invisible force that moves modern markets. When liquidity floods the system, asset prices rise. When liquidity disappears, markets collapse. And once you understand how this liquidity machine works, something very unsettling becomes clear. Modern financial markets are not standing on solid ground. They are standing on a system that requires constant intervention to survive. And the moment that intervention slows down, everything can change. To understand this system, we have to go back to a moment that changed the entire financial world. The year was 1971. At that time, the global financial system operated very differently. The United States dollar was tied to gold. Foreign governments could exchange dollars for physical gold. This created a natural discipline. Money could not be created endlessly because gold reserves placed a limit on supply. But by the late 1960s, something was happening. The United States government was spending enormous amounts of money. War expenditures were rising, government programs were expanding, and more dollars were being created than gold reserves could support. Foreign countries began demanding gold in exchange for their dollars. Gold started leaving the United States rapidly. The system was breaking. Then in August 1971, President Richard Nixon made a decision that permanently changed the financial system. He ended the convertibility of the dollar into gold. The gold window was closed. From that moment forward, money was no longer backed by a scarce physical asset. Money became fiat, which means it exists because governments declare it valuable, and because central banks manage its supply. This decision unlocked a new financial reality. For the first time in modern history, money creation had no hard limit. Central banks could expand liquidity whenever financial stress appeared. At first, this power was used carefully, but over time, the financial system began to evolve around this capability, and eventually something very important happened. Markets began depending on it. Fast forward several decades. By the early 2000 years, the financial system had become extremely complex. Banks were heavily interconnected. Derivatives markets were massive. Global credit markets were deeply intertwined. Then, in 2008, something catastrophic happened. The global financial system nearly collapsed. Mortgage markets froze. Major banks failed. Credit markets stopped functioning. Stock markets crashed. Financial panic spread across the world. And at that moment, central banks faced a terrifying possibility. The entire system could unravel. So they did something unprecedented. They created massive amounts of liquidity. Trillions of dollars were injected into financial markets. Central banks began purchasing government bonds and financial assets. This policy became known as quantitative easing. The objective was simple: inject money into the system so markets could function again, and it worked. Markets stabilized, panic faded, confidence returned. But something unexpected happened. Markets did not just recover, they began rising aggressively. Asset prices surged, stocks climbed higher, real estate prices began accelerating, and investors slowly realized something powerful. Whenever markets faced serious danger, central banks would step in with liquidity. A new expectation was born. The system would always be rescued. And that belief changed investor behavior forever. Once markets experienced this rescue mechanism, something psychological began to change. Investors became more comfortable taking risk. Why? Because they believed central banks would protect the system. If markets dropped, liquidity would appear. If banks struggled, liquidity would appear. If crises emerged, liquidity would appear. Gradually, the financial system developed a new addiction: cheap money, low interest rates, easy borrowing, and enormous liquidity injections during crises. This environment pushed investors toward increasingly risky assets. Technology stocks soared, venture capital exploded, speculative investments multiplied, debt expanded everywhere: corporate debt, government debt, consumer debt. The entire financial world became larger and more leveraged. And the engine powering this expansion was liquidity. But the real demonstration of this system arrived in 2020, when the global pandemic shut down economies across the planet. Financial markets collapsed at record speed. In response, central banks launched the largest liquidity injection in history. Trillions of dollars were created. Governments distributed stimulus money. Interest rates dropped near zero. Financial markets recovered almost immediately. And then something extraordinary happened. Asset prices exploded higher than ever before. Stocks reached record highs. Real estate surged. Cryptocurrency markets erupted. Speculative investments became wildly popular. And this revealed something extremely important. Modern markets no longer moved primarily because of economic productivity. They moved because of liquidity. But every system has a weakness, And the liquidity machine has a very dangerous one. Money creation cannot continue forever without consequences. Eventually, too much liquidity begins affecting the real economy. Prices begin rising, inflation appears, purchasing power weakens. And when inflation becomes too strong, central banks face a terrible dilemma. They must slow down liquidity creation. They must raise interest rates. They must tighten financial conditions. But here is the problem. Modern markets are no longer built to handle tight liquidity. For decades, the system has expanded under easy money conditions. Debt levels have exploded. Financial leverage has increased dramatically. Asset valuations have climbed to extreme levels, all because liquidity was abundant. But when liquidity begins disappearing, something dangerous can happen. Leverage unwinds, credit conditions tighten, investors rush to sell risky assets, and markets that once seemed stable suddenly become fragile. This is why financial markets react so strongly to central bank decisions today. Interest rate changes move markets dramatically, liquidity injections move markets dramatically, balance sheet reductions move markets dramatically, because the liquidity machine now controls the rhythm of the financial system. And when that rhythm changes, markets react immediately. This leads to a question that many investors avoid asking. What happens if the liquidity machine stops working? What happens if central banks can no longer rescue markets easily? Because there may come a moment when the system faces two conflicting dangers. Inflation on one side, financial instability on the other. Injecting more liquidity could worsen inflation. But reducing liquidity could destabilize markets. That is the trap modern financial systems may eventually face, a liquidity dilemma. And if that moment arrives, markets could become extremely volatile, because for decades, investors have operated under one assumption: liquidity will always appear. But if confidence in that assumption begins to fade, financial markets could react very differently. Sudden repricing, rapid corrections, sharp volatility, because the machine that supported markets for decades may not function the same way forever. For over 50 years, the global financial system has operated under a powerful force: liquidity. It has fueled bull markets, prevented financial collapse, and supported rising asset prices. But it has also created a dangerous dependency. Markets now rely on liquidity injections to remain stable, which means the most important question investors must ask is not about earnings. It is not about economic forecasts. It is not even about corporate growth. The most important question is much simpler. Is liquidity expanding or is liquidity tightening? Because when liquidity floods markets, prices rise easily. But when liquidity disappears, markets can fall faster than anyone expects. And understanding this hidden engine may be the most important advantage an investor can have. If you want to understand the hidden forces shaping financial markets before most investors notice them, subscribe to the channel, because the next videos will reveal the deeper mechanisms behind financial cycles, market crashes, and wealth transfers that shape the global economy. And once you understand how this system really works, you will never look at markets the same way again.